Good morning, and welcome to our market analysis. Today's market snapshot reveals a clear divergence in global performance, with U.S. equities leading the charge. All three major U.S. indices closed higher. The Nasdaq Composite was the strongest performer, surging by 2.13% to close at 25,913.90 points. The S&P 500 rose 1.48% to 7,600.50, and the Dow Jones Industrial Average gained 1.32%, settling at 53,178.41. Futures markets are also showing positive momentum, with Nasdaq futures up 1.06%, S&P futures up 0.96%, and Dow futures up 0.97%, suggesting this upward trend may continue. Accompanying this equity strength, risk appetite appears to be returning. The VIX Volatility Index declined by 0.81% to 15.86, while the 10-year U.S. Treasury yield saw a significant drop of 1.24%, falling to 4.69%. The simultaneous decrease in both VIX and bond yields provides independent validation of a rebound in market risk preference. Capital flows were unequivocally directed towards U.S. technology and growth sectors. The Invesco QQQ Trust, a proxy for the Nasdaq 100, climbed 2.28%, ARKK Innovation ETF was up 3.64%, and Nvidia soared by 3.87%, indicating a clear net inflow into growth-oriented risk assets. In stark contrast to the robust U.S. market, China's A-shares showed independent weakness. The Shanghai Composite Index fell 0.59%, the Shenzhen Component Index dropped 0.96%, the CSI 300 was down 0.98%, the SSE 50 declined 1.23%, and the Chinext Index, representing growth stocks, fell by 1.24%. Both large-cap and growth styles experienced synchronized declines, suggesting either capital outflows or a wait-and-see approach from investors. The commodity market also presented a significant anomaly. Brent crude oil plunged 7.48% in a single day, while WTI crude oil registered a modest gain of 0.3%. This sharp divergence in crude oil benchmarks is the most prominent unusual event of the day, lacking any immediate public explanation. Tracing the global path, the Asian session saw A-shares close lower, indicating a defensive sentiment. However, during the U.S. trading hours, all three major indices rallied, with technology and growth stocks clearly outperforming. AI computing hardware led the gains, with Nvidia up 3.87% and Tesla up 4.14%. The decline in the 10-year U.S. Treasury yield and VIX created a risk-on synergy with U.S. equities. This demonstrates that the U.S. market did not follow Asia's weakness but instead showed a counter-trend strengthening. The market inflection point for the day occurred during the U.S. session, shifting risk appetite from prior adjustments to recovery. Regarding our morning brief's validation, the primary call for an upward direction was largely correct for U.S. markets, evidenced by the Nasdaq and S&P gains and the VIX decline. However, the expectation for A-share growth to show independent strength proved incorrect, as the Chinext Index became a major drag. Similarly, the prediction of divergence within U.S. AI hardware was also inaccurate, as it was a broad-based rally. The largest expectation gap was the failure of A-share and U.S. market. A-shares weakened across the board, while U.S. tech stocks surged, creating a significant decoupling. The market appeared to disregard the substantial drop in the 10-year U.S. Treasury yield, which typically benefits growth stock valuations, suggesting A-shares are currently driven more by internal capital and sentiment. Analyzing the trifecta of markets, currency, equities, and bonds, we observe that on the currency front, the DXY saw a mild rebound, but the RMB remained largely stable, indicating external currency pressure was not the primary driver for A-share weakness. In equities, U.S. and A-shares moved in opposite directions, with capital flowing into U.S. growth stocks while exiting A-share large caps and growth stocks. Their pricing logics appear to be decoupled, with A-shares temporarily detached from global risk appetite anchors, driven more by internal factors. In the bond market, the 10-year U.S. Treasury yields declined to 4.69% was favorable for long-duration growth asset valuations, aligning with the rise in U.S. tech growth but showing no correlation with A-share performance. The relationship is one of synergy between bonds and U.S. equities, neutral currency, and A-share divergence. Looking ahead, for the Asian market, particularly A-share Chi-Next, we anticipate a technical rebound and potential volatile recovery. U.S. AI computing hardware is expected to maintain its relative strength, continuing to outperform the S&P 500. The 10-year U.S. Treasury yield is likely to trade within a range of 4.65% to 4.75%, with a downward bias. The price spread between Brent and WTI crude oil is also expected to narrow or correct. Our strategic inclination for the next trading day is to maintain controlled long positions, primarily in U.S. technology and growth sectors, while adopting a wait-and-see approach for A-shares. Conditions for initiating positions include the 10-year U.S. Treasury yield remaining below 4.75%, VIX below 16, and U.S. equity futures maintaining positive gains pre-market. For A-shares, we do not recommend adding positions. If the market opens higher tomorrow, we will observe if the Chi-Next index can reclaim 3,330 points, which would signal short-term stabilization. Otherwise, we will maintain a defensive stance. Our probability assessment for tomorrow's market is 40% for an upward move, 35% for sideways consolidation, and 25% for a decline.